All right, good afternoon, everybody. Welcome to the first webinar of the new year. Happy New Year, everybody. We're going to talk about the market. And I'm also excited about telling you a little bit and covering a couple strategies for the first new class of the year. I always labor on which class to do at any given time because I want to make it useful. Is it relevant with the market? And I'm really excited about this class. So we will talk about it. So let's jump in. The first thing we're going to do is just for a few minutes before we jump into strategies, the new class that we're going to be doing for the year, which starts a week from today, and that will be January 12th, will be on broken wing butterflies with a bonus of directional butterflies. And let me explain. This is the first, broken wing butterflies in our community has long been a staple, one of our key go-to strategies for weekly and monthly income. But this is going to be the first time ever that we have conducted a class on broken wing butterflies. We haven't done one in over a year, but this is the first time ever that we've done one with the VIX, in this high end of the range, 20 plus. And today it's down almost a couple points at 25. So it'll be different because we're going to have different widths, different strategies on it. So I'm excited about that. Mark Fenton and Jay Bailey also will be helping with that class. They have some very effective broken wing butterfly strategies. But then as I was thinking about this, what would be, do I think is time? We haven't really addressed broken wing butterflies, or frankly, we haven't really traded that many broken wing butterflies the last 9 months, believe it or not. But now we're starting to jump in and we'll go over all that. But I think you'll really like that. And that's something we've really spent a lot of years on. But I think this in this higher vol environment makes it more intriguing. The bonus we're going to throw in, another one of the more effective strategies in shared and mentoring lately, over the last 2-3 months, we've been doing these directional butterflies. And they're basically cheap speculative plays in more expensive stocks. But this has been a very effective strategy. And it still is. And I'll bring up an example. And one of the vehicles we've been using lately that's been working really well for this. And so I think this 3-week class starting a week from today, January 12th, it'll run Tuesdays and Thursdays at 1 Central, go about an hour or a little bit more, but about at least an hour. And again, all the classes will be recorded and archived. And you can ask questions during the class. You can ask them recorded. There'll be a class page, Ask Dan a question, and I'll filter if the question's from me or Mark or Jay. And then the class as usual, we do a 3-week class every month. They're all the same, $297. And so, the class stays archived after the class. So let's jump in and look at things here. So the big news here, in the market is today. Well, not big news. I mean, it's some news, right? But the news today is the election in Georgia, and I guess, and the consensus would be what? To me, it's more of a binary event. If the Republicans win the Senate, which way will we probably go tomorrow? At least a one-day thing. What do you think, up or down? If the Republicans win the Senate, it'll probably go up. And if the Democrats win, perception, which way will we go? At least that's down. I think other than some one-day event, I'm, from a long term, I don't know if it'll matter that much, right? I mean, sure, because, again, I think the Federal Reserve does a lot with this stuff. So I don't think over 6 months, but, for a binary event. So we're kind of telling our students going into tomorrow, play a little bit smaller for the range bound trades and, wait till this thing is over. And then we'll be able to going. I think, and I'll tell you my thoughts on the VIX and stuff in a second. Anyways, I think that's the big news. Stimulus, but a lot of that is discounted. As we look at the market, for range bound trades, the last 7 weeks, we've been pretty range bound. Last 3 months, the VIX has been maybe 20. It's kind of the range to 28. And right now, the VIX is about 25, just a little bit over the middle. I think of this event tonight with the election, buy the rumor, sell the news. Unless they destroy the market, what do you think volatility will do tomorrow? If there's just SPX is up 30 or down 30, I think VIX will go down, right? Unless the only way VIX will not go down is if they take the SPX down like they did yesterday. Was it yesterday morning? Was it yesterday or Monday? Today's Tuesday. So Monday, at what point the SPX was down by 80 points. Anyway, so I wouldn't get too caught up in the one night thing. Anyways, so this is where the VIX range is, kind of what I'm going by, 20 to 28. We're kind of in the middle. Again, I think for the most part, we're still range bound in the SPX, which we've been over the last 7 weeks, which has been nice. The new class we're doing will be more in the income part of the portfolio. Real quick, I just want to give you a little just quick perspective, and then we'll jump into butterflies. But, at Sheridan Mentoring, we look at the complete options portfolio. Any trades you can think of would go into one of these three. Any trade you can think of goes in one of these three. So we set up kind of a business here. This is your complete options portfolio, whether that number is 50 grand or 10 grand or 5 grand options portfolio, or 100 or 2, whatever the number is. But, you have long portfolio, which is more neutral to bullish. And these are strategies would be covered rights. Now we do a alternative to the covered right without the stock that's much cheaper and better yield, a long diagonal. Then you have cash secured puts. We do an alternative to the cash secured puts, which is, again, much better yield, much less risk in capital. We call it a wide credit spread. Also in the long portfolio could be long stock. It could be long leaps. Again, I'm just abbreviating these for time. We do a lot of put credit spreads in SPX in this. But again, this is an intentional, this isn't the directional part of the portfolio. And these are more in stocks or indexes that you like over time. The income or range bound part of the portfolio is just what it says, range bound trades. And when do you usually trade range bound trades? When there's some type of a range, right? And we have some indicators to keep us out when things really aren't range bound. And this would be more your iron condors, calendars, various flies, of which we will be highlighting. And again, we're going to be covering, which is neat, first time ever, broken wing butterflies in a higher vol environment, and really put a good emphasis on directional flies. These have been a very good trade in our community. Also, iron condors, calendars, flies, double calendars, double diagonals. These are more range-bound trades. And again, intentionally, we'll put X amount of dollars in here. Now, spec part of the portfolio, that's, you have an opinion, right? And again, there's many different ways to do it. You can buy a call. You can buy a put. You can buy verticals. You can do directional calendars and flies. These are all directional based on an opinion or spec or technicals or whatever. Directional calendars, directional flies, which we're going to be covering in this class. So you have the consistent income of the flies and the spec directional flies, which are going for a much higher yield. But you get the idea with directional and or spec. So let's just say a 50K portfolio today with VIX in the lower end of the range, SPX high, let me ask you a question. A lot of this, we can do this together. So if we had a 50K portfolio today, and we're going to put it in options, what part of that portfolio do you think, there's no wrong answer, on the long portfolio? What do you think? What would you allocate on a 50K portfolio to these trades, long portfolio? 40%. Yeah, some might do 40. Again, January could be more volatile, but taking where the market is today, you're right. The long portfolio would be 30 to 40. I might put, let's put 40%. And on that, say, how many trades, Dan, would that be a week or a month or whatever? I'd probably put, for me, some people in our community might do 4 or 5 trades if they're doing long diagonals in stocks or something. But I might do, a lot of our students will do like SPX, excuse me, SPX, put credit spread, and then they might do a long diagonal in a stock or two, right? So that's a couple trades a week. And then you might do, but because we are in the upper end of the range, even though it's 40%, I might be closer to 30, but 40 is a pretty good number. Then the other number would be income or range bound. We're still range bound, but I'm anticipating more volatility, which we've had Monday. So I still would be around 40% right now for the range bound. And then I would be maybe 10% spec and 10% cash. If this were a more like a portfolio margin account, I'd keep 50% in cash. In a Reg T account where you're putting up your risk on every trade, I'd be something like this, right? Anyways, and again, this would be the long portfolio. I might put 1 to 2 trades on per week. Range bound, maybe 1 to 2 trades. We've been doing a lot of calendars, but now we're doing more flies. Spec, maybe 1 trade a week. It depends, right? So that's an idea of this portfolio. All right. So let's look into first trade I'm looking at, just giving you an example. These are just examples for the new class. We're going to be talking about butterflies, broken wing butterflies. So broken wing. So I'm just going to kind of just introduce this stuff. So here's an example in Jan 29, SPX. And we are 24 days out for Jan 20. I'm just using this as an example. And so here's a butterfly, buy 1, sell 2, buy 1. Again, this is the expiration. It's many days out. And I'm just using calls for now. Let's say I buy the 37.90, 37.20. Again, a butterfly is the combination of a debit spread and credit spread, where your short strike is the same on both. It's a range-bound trade. Again, in my graph, here's where the underline is right now. Oh, we've moved. I better tweak these strikes because we have, let me do this real quick, because we have moved since the SPX has started rallying. Agree? So let me move this to, let's just say 37. You changed because we've rallied in the last few minutes. 70 points, 37, 35, 30, 30, 805, down 70, 36. Now explain this. It's harder to do math when you have 5. When it's even numbers, it's easier for me. Let's see, 65. That looks good. All right, so here we are, folks. 1, 2, 1. We're looking at Jan 29. 24 days out. Calls. All Our short strike is 37.35. We're basically at 37.33 right now. We've rallied. And this is called a butterfly. We're buying the 38.05s, selling the 37.35s at the money. So this would be range bound because we're selling the at the money with the most extrinsic value. And we're buying our hedges in the money and out of the money in the calls with less extrinsic value. The cost of this is around $11.50 debit. That's about our risk. This is a 8. The distance from our short strike to our upper strike call is 70. The distance between the short strike and the lower strike call is 70. So you can see again, this is our graph of what this looks like today. This is the graph at expiration in 24 days. What do we call this type of butterfly? What do we call this type of butterfly? I will get more into choosing the wings during the class. The further out duration is going to be wider. The closer duration, closer we are to duration, will be narrower. And we'll go into some formulas and stuff I use during class for how to get the proper width. This would be called a balanced butterfly. So your distance between the short strike and each of your longs are the same. And that's going to be a cheaper butterfly than the unbalanced. And again, what's the purpose of a butter? You can see the graph. If it doesn't move a ton, you could see on basically an $11.50 investment, you could see, I mean, again, the most you could possibly make is if we closed at the short strike in 24 days, you could make, 4 or 5 times your money. Now, is that realistic? Yes or no? Is that realistic that we're going to close exactly at our short strike in 24 days? Is that? No, of course not. But to start there, to just see, how is this graph? How does a butterfly make money? Well, if we closed at the short strike, this thing that we sold 2 of with more extrinsic value than the longs will go to 0. These options will hold. They'll be in the money. This will be out of the money. This will go to 0. This will be at the money. This will go to 0. These will be in the money. Those will have some intrinsic, but you're going to make more on your shorts than you lose on your longs. Why? Because you sold a lot more extrinsic value than you bought. So this 11.50 will swell up. Will go, it'll go up to, you'll buy it at 11.50. It can go up to $20, right? Not 20. It could go up to the most you can make it. Maybe this goes up to, 16.50, right? Then you make more than that. But the point is, the debit would increase because these things are going to get hammered, right? Now, what's the problem? This is a balanced butterfly. More than not, we do unbalanced butterfly. Why do you think we do an unbalanced butterfly more than we do a balanced? An unbalanced just means that one of these sides is less than the other side. And we'll get into that. Why? Why do you think we do unbalanced butterflies? Because we have a directional bias. Any other thoughts? Upside risk? It has nothing to do with direction. Absolutely nothing, right? Nothing. Why do we do? Here's my Greeks. I'm -3 delta short. Here's my gamma of this balanced butterfly. Here's my theta. Here's my vega. Here's where the underline is. This is the graph at expiration. That's fine. But if you see the graph today, I do better on the downside. Not as good on the upside. Why? I'm about 3.5 delta short. It's not that big a deal. But the main reason, in a lot of cases, we turn a balanced butterfly into an unbalanced is to get the deltas closer to 0. So for example, if in this example, if I took the upper strike call and move that down 15 points. Watch what happens. I'm going to take the 38.05 strike. That's my upper strike call, right? So this is the trade. So this would be balanced. And I am minus 3.5 delta short. And you can see this deltas. And you can see this, we call this the T+0 curve, the graph today. Again, here's where the underlying price is right now in SPX. So you can see not as good on the upside as the downside. Now, and we'll discuss that more in our class. But so what do? Take my, in this case, we have 70 wide, take my upper strike down 15 points from 38.05 to 37, let's say 90. So take this from 38.05 to 37.90, and now watch what happens to the graph and everything else in life, right? So I'm going to take this from 38.05 to 37.90, and oh my, right? What do you notice? My T+0 curve, much smoother. Smooth as a baby's behind. Beautiful. My deltas, beautiful. Nice positive theta. Right? That's the plus. That's beautiful. What else is a plus? Why these have become popular like in uptrendy markets, much less risk on the upside. Now again, do we construct all broken wing butterflies exactly like this? No, it depends on the duration. It depends on a lot of things. But this particular one now, right? If I replace the 38.05 with the 37.90s, right? Now my size, now it would be 70 width on the downside, and on the upside, the width would be 55. But now I've got a total of our maximum risk on the upside is 320. My maximum risk on the downside has gone up to 1800, but I'm delta neutral. And so, and I'm paying about $18. So we've gone from, what, 1200 to 1800. So you typically can go up, depending on the butterfly, you can go up anywhere from 20 to 40% or more, right? Again, some aren't as much. This is a 55, 70 broken wing. Some broken wings I could go 45 to 50, and that's going to be less margin. But anyways, this is just an example. Does everybody understand at least some of the stuff? Well, Sanjay says, so my point, it does come to some directional bias. No. In other words, I didn't make this, Sanjay, when I decided, for the most part, if I'm deciding to get the deltas near zero, right? Just one of the consequences of lowering my upper strike takes my deltas to zero, right? And I have less risk on the upside. But I didn't make my decision, hey, I'm bullish. I am going to get the deltas neutral. I mean, if your deltas are neutral, right? If your deltas are neutral and we go up $10 or down 10 points in the SPX, should it matter? Yes or no? If you're neutral and we go up 10 or 20 points in SPX or down 10 or 20, should it be that big a deal? No. That's what I'm talking about, neutral. These have become popular in an uptrending market because you do have less risk. They're easier to manage. But that wasn't the reason, because you think about it. If I was bullish, if I called you up and said, Sanjay or Sid, hey, I am bullish in SPX, right? Now, you're looking at the graph. But if I called you up and said, Sanjay, I am so bullish. What if Sanjay said to me, hey, Dan, what are your deltas? I'm neutral. Dan, that doesn't make sense. You're neutral? And if we go up 20 points, what are you making? Nothing. Don't get caught up in the expiration. And another thing is, should we get caught up in the expiration graph? This is a 24-day trade. I don't remember ever in my lifetime for as a retail, since I switched from the CBOE to retail trading, ever having a trade on at expiration. On a 24-day trade, probably the longest we would be in this trade would be a week to week and a half. That's it. So we're not holding these. Anyways, this is an example of a broken wing butterfly. And again, we'll talk. We have very specific broken wing strategies that we teach, and we will be tweaking for the higher vol environment. I think you'll get a lot out of it, and these are one of our go-to strategies. The other one I want to share, one that's been hotter than a pistol in the community, and this has been spearheaded by my cohort in crime, Mark Fenton, found this one. This is a gold. If you look at a chart of gold, since probably the end of June, or since the end of November here, about November 27th, has kind of moseyed its way. Which way? Which way has GLD kind of moseyed its way? Pradeep says, in the class, do you teach how to scan for these potential candidates for these unbalanced flies, or is it all SPY? No, we'll tell you even better than scans, Pradeep. We're going to show you exactly the vehicles that people are in with live money over the last 1 to 5 years. What are people trading, right? So we don't, it's not just SPX. That's basically our key one for non-directional, but there's other vehicles other than gold. But we don't, for these, we've got students in, we've kind of found what we think are the better vehicles for this. So we don't really use scans for this. Again, scans to me are more, you're trying to find a certain vehicle, maybe this type of volume and stuff like this. We have we have criteria for finding directional butterflies, which we'll share what we look at as option traders. But it's going to be a little bit different for many reasons than just, something like an IBD formula or something, even though I think IBD is, pretty good. All right. So as you see, gold has been trending up. But again, I think risk management is always going to be the key. But so here's something we've been looking at is, so taking this concept of a butterfly. So in our class, each class will cover broken wing butterflies and the different specifics, how we trade them. And Jay and Mark have some very specific strategies. I do too on that. And then each class will be a directional fly. And right now, one of the ones we're doing is gold. So with gold at, let's say, 183.07, I'm going to put a butterfly on that expires January 29th. That's in 24 days at the 190 strike. And it's going for about $2.89 debit if you do one. Excuse me. So you're buying the 180, selling the 190s, buying the 200s. This is an example, and we'll show you. Sometimes we do them 5 wide, sometimes we do them 10 wide, but you can see here's the underlying. Here's the purple line. That's today's graph. This is expiration in 24 days. And you're starting out a little more deltas, right? But again, if we pay $2.89, what's your total risk if gold goes to zero in 24 days? What's your total risk on this trade if gold goes to zero, which it won't? $289, right? $290, whatever. So this is the butterfly, but you can see what I love about these directional butterflies is they're, in my opinion, the highest potential yield spec trade in the business. In other words, if you compare a long call to the upside, or a long vertical to the upside, or a butterfly to the upside, can you make more in a long call than a butterfly? Yes or no? Can you make more in a long call? But which has a lot more risk? Which has a lot more risk? A butterfly or a long call? So the butterflies, though, have the best potential yield out there. And what I like about it is directional butterflies let you play all the rock and rollers in the market, all the crazy stuff, all the you can play any kind of vehicle directional. It doesn't have to be a crazy one. It could be it could be Microsoft. And I think these are very forgiving. I think these are probably the only directional trade I really do. So anyways, this is what we're going to be covering a week from Tuesday. It'll be a 3-week class. Jay, Mark, and myself all trade these pretty heavily, directional and broken wing butterfly. And we will go over risk management adjustments. We'll have live trades, probably 2 live trades every class for illustrative. So look forward to working with you. If any questions, you can email me, dan@SheridanMentoring.com. We will send an email out on this. For sign up, you could sign up on the front page. The class will be $297. And we'll probably also have something in there, what are our next 3 classes, and a little bit of a discount, if you get the 3 classes for, we do a class each month. So we'll send you out that information, but look forward to having you. This will be a 3-week class. Starts a week from today. That'll be January 12th. 3-week class. Goes Tuesdays and Thursdays, 1 Central. So it'll be a total of 6 hours and 2 hours a week, 2 classes. So you mean Tuesday for an hour, Thursday for an hour. Hey, Dan, I'm working, or I go bowling on Tuesdays. That's okay. Classes will be recorded, archived for you. And then there'll be a class page for you where you can get the PowerPoint slides if you want to ask a question. And they're archived months after. So look forward to seeing you at the class. Have a wonderful day, and we will see you later. Thanks.